All right, guys, that's what I got from the news perspective. If anybody else has any other news items, absolutely bring them in here. But we are going to be transitioning to our last segment here today, which is the weekly edition of Buy One, Hold One, and Dump One, where Coach Greg finds three fundamental companies, and which ones he loves or doesn't. He doesn't tell us that. He lays out kind of the data and the detail behind them, what they're doing from a balance sheet perspective, a dividend perspective, payout ratio perspective, lays out the argument. Then as coaches, we get to decide which one we would buy, which one we would hold, and which one we would dump. Greg, I'm interested in today's segment, retail, man. What you got here today? TJ Maxx, ROST stores, and Target is what I heard from your pre-production. Now, where we're starting from?
Yeah, so I looked at discretionary today. If you bring up that ETF for me there, Ty, it's been running recently. It's trying to get back to those highs there, that 180 zone there. So nice extended run the last couple of weeks or so, maybe 3 weeks there. So I thought, it's showing a little bit of strength, above that 50 MA, just chugging along. I just liked where the action was going for that. Even after this pullback, back in May there. So looked at that and I thought, okay, well let's see what's in there. I looked at all the holdings and tried to put them together, and that's where I came up with three retail. So they call them specialty retail. So I wanted to kind of put three together that people would recognize and kind of have an idea of who they are, and maybe just a little bit understanding from a personal standpoint of these companies. So TJ Maxx, Target, and ROST stores, all retailers in the States, I believe. Like I said, kind of household names. At least I'm a Canadian and I know of all of them. So I'm assuming that our friends in the States do as well. So if we look at Target first, I'll run down some data here. I sent it to Tyler there. He'll put it up after we're done. So there's going to be a couple of caveats here that I'll get into when I get into the last two picks here, but we'll go through Target. So Target's it's a higher dollar stock. It's 230 some odd dollars. Was 230. So let's say it's 239 now. It was 237 when I looked at it today. So good on it. So looking at that, it's expensive stock, but it's a quality company that everybody knows. You've got that brand loyalty there, right? So their dividend is about 1.52% right now. They've got 49 years, almost 50 years of consecutive dividend increases, which is quite impressive. They started paying dividends in 1965. Now they have a paltry 22% payout ratio, which means they're only paying 22% of their earnings out in dividends, which means they've got a lot of room if they ever wanted to raise their dividends, which, as you can see, they've been doing quite well for a long time. Mm-hmm. The PE ratio that I found was around 19. And we start looking at their fundamentals, their strong fundamentals. Assets versus liabilities, total assets of about 51.2 billion, total liabilities of 36.8 billion. So a fair bit of extra there to continue working in the company there. They have around 8 billion in free cash flow, and they have 4 years of consecutive increasing net income. So 4 years in a row, their income has gone up, which is a quality metric for sure. And then just looking at sales growth, if you look at the chart itself, as you can see, it's been kind of running for a while now. Got a real nice channeling action here, just a juggernaut really, and quality companies tend to do that some of the time. So like I said, metrics wise, their sales growth this year is around 45%. And they're expecting, sorry, I apologize, wrong one. Their sales growth this year was 8.8%, and they're expecting a sales growth of next year of 2%.
Okay.
So that's how Target looks. So let's go to TJ Maxx as the next one. TJX. So a little different chart here, right? Had a pullback, showing some strength, got some overhead resistance there. You can see you got the 50 MA in play there. You've got an old resistance level just before you hit that as well. So could be some challenges here. Kind of stuck that landing at the 200, which I thought was good, and then starting to work its way higher. I think there's potential here. If you can break that 50, obviously you've got to run up to 75 there. So I think there's a bit of potential for price appreciation here as well. And then we'll get into the metrics of it. So if we go and look at the metrics of TJ, so about a $66 stock, 1.58% for a dividend. Now, I have 0 years of consecutive dividend increases, but I have to qualify that. That's where the caveat comes in. So last year for both TJX and ROST stores, they cut their dividend in 2020. Okay, so pandemic year, you can either choose to include that or not include that. I personally looked at the data for the previous basically 20 years. They both had consecutive dividend increases every year. It was only the pandemic year where they pulled back. They've been back up to their numbers again this year. So take that with a grain of salt. But basically, by the numbers, they have 0 years of consecutive dividend increases. They started paying dividends in 1980. Their payout ratio is around 42%. Now, their PE ratio that I found, and again, please, these numbers are subject because you can find different ones everywhere. But I saw a PE ratio of 53.
Yeah, me too.
A bit of a higher PE ratio there. Balance sheet wise, they had 30.8 billion in assets versus 24.9 in liabilities. They got just about 6.7 billion in free cash flow. And again, their years of consecutive net income increases is again 0 because 2020 was a year where their income pulled back. The 3 previous years to that, they did increase. It's just 2020 kind of cut that short. Sales growth. Here's some sales growth numbers for you. 43.2% current year sales growth, and they're expecting 6.9 to 7% for next year's sales growth. So some pretty solid numbers for sales growth there. Mm-hmm. All right, and if we can look at ROST stores next. So very similar chart to what we saw in TJ Maxx. Took a bit of a beat down there. Held up above that 200 MA, pushing its way back up to the 50, but obviously we know that can act as resistance. If it gets above there, again, I think you get a run back up to those highs there. So there is the potential there for a little bit of price appreciation. $120 stock, so about twice what TJ Maxx is. So you got three companies today with very different price tags. But all kind of in the same industry there. So numbers wise, it's going to look a lot like TJ Maxx. Your $120 stock. Their dividend payout is 0.94, so not quite 1%. Same scenario as TJ Maxx in the fact that they have no years of consecutive dividend increases because of the pullback or the clawback in their dividend in 2020. But if you take the data before that, it's just shy of 20 years of consecutive dividend increases there. They started paying dividends in 94. Their PE or their payout ratio, is 23%. So they got lots of room to up their dividends. They've got a PE ratio of 50. Now they're a bit of a smaller player here. They've got assets of 12.7 billion and liabilities of 9.4 billion. Their free cash flow is sitting at 3.6 billion, and again, 0 years of consecutive net income increases. Sales numbers wise, they had just under 45% this year, and they're expecting 7.7% next year. So very similar numbers to TJ Maxx.
All right. And then Tyler, I believe you kind of compiled, Greg compiled the data, gave it to you, and now we can kind of go through it a little bit one at a time. I'm looking at these 3 companies, obviously all in retail in some fashion, but one of them very different than the other 2, pretty obviously. Target is more that big box, brand type of retail type of company, where TJ Maxx and ROST stores, discounted retailers, more of the clothing line type of companies alone, although Target does still obviously sell clothes, but that's not just all they do. So those 2 are more close to each other than Target. Tyler, what are you seeing in the data, and kind of walk us through it one more time as we can see it visually here, so we can think through this buy one, hold one, and dump one decision-making process.
Okay, and I think I got my mind made up as well. So, so just to recap, so you can see the numbers that Greg was going through here. Target, most expensive stock from a price perspective. Dividend yields in the middle, 1.52. The dividend increase, I'm impressed. 49 years, that's pretty impressive. Started paying out in 1965. Now, I do math here. 1965 plus 49, 2014. Does that mean there was a couple years in there where they weren't increasing dividends?
Looks like in the
takeaway?
late 60s or early 70s. Yeah. So from 1972, they've been increasing dividends, I believe.
Look, late 60s was a tough time for specialty retail. It's okay. It's okay. 22% payout ratio. I like that, lowest of all three. So they got plenty of money to increase the dividend per Greg's comments. 19 PE ratio, 8.8 sales growth, 2%. Next year, assets liabilities, 51 bill versus 36 billion, 7.9 free cash flow. That's billion. And then 4 years of increasing consecutive net income. That means they increased their net income last year, correct, Greg?
Yes.
If I was Target, I'd be like, what pandemic? Look, man, we still increased our net income during the pandemic.
Well,
That's
you remember,
impressive.
I mean, here on the halftime report, Matt and I talked about Target quite a bit through the last 15 months. Very popular company. Also on one of our lists, as well on the Tackle 25 Poor Boy Covered Call list. But they had really, really good metrics and numbers around online sales, deliveries, pickup, all that kind of stuff. I mean, they really did. They were already moving that direction. This whole industry was in many ways, but Target really, took advantage and capitalized on the dynamics and, really, really did a good job building revenue through those outlets. Yeah.
It will take more than a pandemic to keep the modern day housewife away from Target.
That's true.
That we know.
Although I love Target too, so I don't think it's just housewives, but I get the point. I think that's Tyler talking his book right there. But I love Target, so all right, a great one here. What about the other two here, Ty?
So TJ Maxx, $65 stock, highest dividend yield of the three. Although it's paying more of its earnings out in dividends than the other two. So there's reason for that. 53 PE ratio, which I suspect is just a byproduct of stock price has gone bananas in the wake of the pandemic and earnings simply have not gone up as much, right? Sales growth really good this year, which tells me it's because it was coming from a low base last year. And then you get back to normal starting next year, 6.9%, probably more typical. Assets, more assets than liabilities. Ratios looks kind of similar than the previous one, if I'm eyeballing it here. Maybe a little worse, actually. But regardless, free cash flow, 6.7 billion. And then your asterisk there is the 2020 was, what did you say it was before? If you
So the three
2020?
previous years, yeah. So 17, 18, 19, they increased their net income.
Okay.
2020, they dropped it. Now, again, just speculation on my part. I don't know how the opening was affected, whether Target being a big box store was allowed to be open and maybe the TJ and ROST stores were closed at some point. I don't really, I know here in Canada, we had some of that, like the clothing stores, just the straight clothing stores were shuttered for a while, whereas the big box stores were allowed to be open. So that could have affected it. But yeah, that's what I'm seeing is the net income with the three previous years was increasing. It's just that 2020 number hampered both of those. That's why I've got that asterisk beside it.
You know what TJ Maxx should have done? I don't know about the Targets here in Utah. They got a little grocery section.
Mm-hmm.
Some of these retailers just should have put a little grocery section in the front corner.
Should have bought a bag of oranges and put up a little table, and there you go.
Hey, what? People need
store.
food. We should stay open. Yeah. All right. ROST stores, $120. Dividend yield 0.94%. It is not paying as much of its earnings out in dividends. PE ratio 50, big sales growth, which again, coming from the low base last year, that's returning to normal. And then going out next year, 7.7%. 12.7 assets versus 9.4 billion in liabilities, 3.6 billion in cash flow, free cash flow. And how many years was, if you don't count?
Same 3 years. Yeah.
Okay.
Yeah.
All right. Tim, you want me to go first, or you locked in?
I'm locked in on the one 1,000%. But the other two, I'm still kind of waffling on. You go first, young man.
Okay.
Let me hear what your thoughts are.
All right. Well, I think the easy choice would be Target. Okay. And the safe choice would be hold it because it's fantastic. But I'm going to go even further than that to express my enthusiasm for this company. And I'm going to say buy. I'm going to say buy Target for 2 or 3 reasons. Reason number one, they killed it last year, which is impressive because really I think 2020 was a separating year between has their crap together and who doesn't. I'm impressed by that in terms of their earnings performance. I mean, look at the PE ratio. Why is the PE ratio so low? I mean, in today's context, a 19 PE ratio is pretty low. Somebody check real quick for me what the S&P 500 PE ratio is. I don't think it's 19. I'm pretty sure it's more than that.
I think it's a little higher than that. I'll look.
The Schiller PE ratio is like 34.
What do you know what the trailing 12 months is?
12 months, probably around 21.
Okay, so you're getting this cheaper than the S&P, which is very, very impressive given how much the dang stock has gone up, right? For Target to be able to go from 100 to 240 in a year and still have such a low PE ratio tells you something about how impressive their earnings growth has been, right? So it's not as if I'm overpaying from a valuation perspective. That I think is impressive. They almost have the highest dividend yield. They don't by whatever that is, 0.6%, or I don't know if I said that right, but you get it. But they're only paying out 22%, whereas TJX, to beat them on the dividend yield front, has to pay almost half their earnings out in dividends. That I find impressive. I don't care about the sales growth and next year being lower. Whatever, they're killing it. I don't care about that. All that said, plus the chart, plus the history. Come on, man. What's not to like? So Target is the obvious buy for me. So then it comes.
Yeah, go ahead.
Then it comes down to the other two, right? Which one do you hold? Which one do you sell? And so it's easier to just say, well, what do I like least in regards to these two? On the fundamental front, I don't know that there's anything major that jumps out at me that I don't like about either one. I mean, if I have to cherry pick, I'd say, I don't know, I like that this one has a better dividend yield. But then you come back and say, well, yeah, that's because 40% of their earnings comes out as dividends. So for me, it's sixes on the fundamentals. Then I just have to go to the chart and I say, okay, TJX is a little bit messier. ROST has a pretty good chart. I think it's slightly better, and my wife shops at ROST and loves it. So I'm going with ROST as the buy, TJX as the sell.
Interesting. So you had Target as your buy.
Hold. So I'll hold ROST. I'll buy Target and I'll sell TJX.
Gotcha. All right, Matt, you want to go next? Or you want me to go next?
I'll go last.
All right, let me think through this. Here's the thing. Can I buy and hold Target and sell the other two? Can I just change
that's what I was doing.
I'm going to do that. I don't want the other two. I'm not that interested. If I have to play the game based on the metrics, and we can change whatever we want, but because it's our game, we get to make up the rules, Greg. I'm buying Target again. It is a clear leader out of these three. There's no question about it. They survived a punch in the nose like all companies did during the pandemic. They came out of it not only ahead. The 2% sales growth is actually not a negative to me for next year. I see that as a positive. After the sales growth they had this year, the size of the company they are, that they're still projecting growth the year after that.
To maintain.
I think that's a great thing. They've got a really good valuation relative to the marketplace. I know the fundamentals are sound. It's on the poor boy covered call tackle 25 list. I'm looking across the metrics. P ratios looking good. Sales increases are looking good. Earnings per share, guys, we're up almost 30% year over year from 2020 to 21 in the last 4 quarters fiscally. So I'm impressed. I love Target. I think you can continue to buy that one. So I'm with you, Ty. I'm going to buy that one. I actually am reading those charts different than you are, young man. I like TJX better on a chart. I'm going to say hold TJX. And the reason I'm seeing it a little bit different is its support right now is testing against an old resistance zone on the long-term charts and some key moving averages. They're so subtly different. They're not a huge difference in the two, so it's really going to come down to the eye of the beholder. But here's one other fundamental metric that did, Ty. All the numbers look very similar. They both got share buyback programs. They both took a hit in the pandemic. Their free cash flow relative to how much their market cap is actually pretty similar to each other, quite frankly. TJX has a lower PE ratio and a lower PEG by just a little bit. So as a tiebreaker, I'm going there, and I like that old resistance play and his new support. So for Tim, I am selling ROST, holding TJX, and easy buy on Target. Matt, what about you?
Yeah, I'm similar, Tim. Target would be a tackle 25, but it was so good it went up so high. That's how good Target is. So I'm going to buy. I'm going to hold. However you want to categorize Target, it's definitely 1A, 1B, 1C for me here in these three. The other two, I'm fundamentally sixes on them, like Tyler is. You know, you can kind of lean one way or the other. I think they're going to run together. They're very similar to companies, but if I had to, I'd pick Ross over TJ Maxx. But it's again gun to head type scenario for me with those two.
Mhm. So Matt would be a buy on Target, then I'm hearing hold on Ross and a sell on TJX. So I was the only one that went a little different on those splits, but close. Greg, what did we miss, if anything, here? What was your take on it?
Yeah, so obviously, there's a chasm of difference between Target and these other two, even though they are in the same space. So obviously, Target's not going to let you down. They've got years and years of consecutive dividend increases, which is right, in my wheelhouse. My only concern with Target is obviously the price tag. Right, if you're gonna be buying some shares of this and holding it to collect those dividends and whatnot, you're gonna be putting out some capital to do so. I prefer my dividend payers to have a little less sting in the pocketbook when I buy them, but understandable. Now you look at it from a PE ratio, and their price is perfectly in line with what they're doing, right? So no argument that way. Understandable. I love all the metrics of all three companies, really, assets versus liabilities. At the end of the day, when you get a company that can pay dividends increasing for, in the case of Target, 49 years, and in the case of those other two with that asterisk, 20 years or, almost 20 years, and yet still have, way more assets than they have liabilities, that to me shows stability, because we've really gone through some stuff in the last 20 years as well. So I think that's important to think about. I love the free cash flow aspect of all three of these companies. They are different sizes, obviously. But sitting on billions is not a bad idea, just in case we do run into some tough economic times, right? So I do like that. And again, I give these two other companies, TJ Maxx, and Ross, I give them a pass for the pandemic. The fact that they cut their dividend for that 1 year, the fact that they're already back to pre-pandemic levels from the dividend for this year, makes me feel that they're going to do okay. So again, yeah, everybody took it on the chin, pandemic. Target was able to ride through it. Again, I kind of spouted off about why I think that is. But at the end of the day, I would hold Target. I'm actually interested in buying TJ Maxx. I do like the dividends, the 1.58%. It is the highest, not by a lot, obviously. The fact that they've got, like I said, with the asterisks, almost 20 years of consecutive dividend increases, that still shows me stability. But for me, it comes down to the price tag. I can buy two TJXs for basically one Ross. And really, the numbers are very, very similar. Growth numbers are very similar. Free cash flow, everything's very similar. Yeah, their payout ratio is a little bit higher, but I'm really not concerned about that. That 42% from a payout ratio for me means absolutely nothing. If they were up around 70, 80%, then that would be a conversation I have. They still have lots of room where they can continue to increase their dividends. So that's not really an issue for me. But the other part to that is, and I guess this is the kicker for me, and I know I'm kind of bringing in another little metric here, but these are the things that I think about, is if I buy TJ Maxx and I buy two of those for every one that I could Ross, I can turn around and sell covered calls, and the covered calls on TJ Maxx are actually quite juicy. They're decent for the type of fundamental stock that they are. So that's when I kind of go to the price tag and I think, okay, how many shares can I acquire for? Let's say I've got a $20,000 stake that I want to put into a stock. I can look and say, okay, how many of each share can I get? How can I create even more cash flow beyond the dividend? And that's really the tiebreaker for me, because rest of the metrics are so similar, right? Their sales growth is right par with one another. From a billions perspective, they're all within line each other too. So that's where I stand. I would hold the Target because I love the stability of it. I would buy the TJ Maxx because I think I can create some cash flow on a still pretty fundamentally strong company, and then I would dump Ross just because I got to play the game.